concept of economic cycles isn't new. Economists and historians have long observed cycles in various economic indicators. The 16-year housing market cycle is rooted in the broader study of economic cycles, drawing parallels with the more widely recognized 18-year real estate cycle. But why 16 years specifically? Perhaps there is a historical basis for this, or it might be a simplification of the longer cycles observed in broader economic theory. Historically, real estate has been subject to cycles due to its nature as a capital asset. Economic theories have long suggested that investments in capital goods like real estate are susceptible to cyclical fluctuations. Factors such as interest rates, credit availability, demographic changes, and government policy can all influence the real estate market's direction. Theories about cycles often consider these variables, yet attributing a specific number of years to such cycles seems arbitrary. Is there historical data supporting the 16-year span? Looking back, the post-World War II era provides a fertile ground for analyzing these cycles. The 1950s and 1960s saw significant economic expansion and suburbanization in many Western countries, driven by a baby boom and increased car ownership. This set the stage for a cycle of growth. However, this was followed by economic challenges in the 1970s, including oil crises and stagflation. From the mid-1980s, the real estate market experienced significant growth, then crashed in the early 1990s. This cycle of boom and bust seems to align somewhat with the 16-year theory. The housing bubble of the mid-2000s and the crash in 2008-2009 added weight to cyclical patterns. Each of these periods was influenced by unique economic, social, and political factors. The 2008 crash was influenced by financial deregulation, subprime lending, and global finance structures in place at the time. While cycles might exist, they are not immune to historical context. The 16-year cycle might be more of a theoretical concept rather than a strict rule. It can be used as a heuristic or a general guide, but not a precise predictor. Investors and policymakers can consider these cycles while acknowledging that various variables can disrupt these patterns. Additionally, regional variations matter. Not every country's real estate market follows the same pattern due to differences in economic conditions, regulatory environments, and socio-political climates. Therefore, the 16-year cycle might hold more relevance in specific contexts. Reflecting on this, the 16-year cycle idea seems more relevant as a lens to interpret historical real estate patterns rather than a definitive cycle. This offers flexibility to understand deviations and unpredictability of economic behavior, with historical context being a key factor. In conclusion, while the theorized 16-year housing market cycle is intriguing, it should be understood with a nuanced perspective. The cycles are complex and interwoven with events and times. The historical approach helps consider these patterns not as inevitable, but as reflections of our past,